Hello everyone, my name is Professor Abdul Qadir R. Siwala, and today we are going to cover a very important topic in income from business profession. Whenever we are calculating income from business and profession, one of the very important section which we will study is the section on depreciation. In this lecture, we are going to cover the theory portion in the depreciation. So first of all, let us start with the definition and the meaning of depreciation. As we can see over here, depreciation is defined as follows. See, the monetary value of an asset, whatever asset you are having, the monetary value of that asset decreases over the period of time. This decrease is due to many factors like its normal use, wear and tear, or obsolescence. Such a decrease in the value of the asset is measured as depreciation. Depreciation is a permanent decline in the value of the asset. In our business, number of assets like machinery, equipment, buildings, furniture, computers, and various intangible properties like patents, copyrights, etc. are liable to be depreciated. Now, when we study income tax and particularly when we are calculating income from business and profession, depreciation is covered under section 32 of the Income Tax Act. Under section 32, depreciation on assets is allowed as a deduction while computing income from business and profession. To claim this deduction, following conditions should be satisfied. Three conditions are given. If all these three conditions are satisfied, the depreciation on that asset will be allowed as a deduction. First condition is that the assessee should be the owner of the asset. That is, the asset must be in the name of the assessee. If, for example, an asset is a building, then the title to that building should be registered in the name of the assessee. If an asset is a plant and machinery, then assessee must be the legal owner of that plant and machinery, and so on. Second condition states that the asset must be used for business purposes. Now, if you are having an asset but you are not using it for business purposes and you are using it for personal purposes, that particular asset will not be eligible for depreciation for income tax purposes. For example, if you are having a motor car which you are using for personal purposes, then you cannot claim the depreciation on the motor car. But if you are using a motor car for business purposes, then you can claim the motor car as your business expenditure and you can claim the depreciation on that motor car. Third condition states that the asset must be used in the previous year by the assessee. Okay. For example, if currently we are in the assessment year 2016-2017, so in order for an asset to be eligible for depreciation, it should have been put to use in the previous year, that is 2015-2016. One more important thing which comes when we are calculating depreciation as per Income Tax Act is the difference of calculation in income of depreciation. In accountancy, we simply calculate the depreciation on percentage basis and deduct that particular depreciation from the value of asset and so show it at the profit and loss account debit side. But when we are talking about depreciation under Income Tax Act, certain things have to be kept in mind. First of all, depreciation is not allowed on individual asset items, but the depreciation is allowed on the block of assets. Block here means group. means all the similar assets are grouped together in a single block, and then the depreciation is provided on that block of assets. For example, if you are having 3 buildings, then the depreciation will not be individually provided for each building. The value of all the buildings will be clubbed, and depreciation will be provided on all 3 buildings as a single block of asset. Hence, here certain important blocks of assets are shown. First is the building, second is all the plant and machinery which you will be having, third is the furniture, and fourth are the intangible assets such as know-how, patents, trademarks, licenses, franchises, etc. The term plant and machinery is a very huge term. It also includes all the plant and machinery which you will be using for businesses, and in addition to that it includes ships, vehicles, books, scientific apparatus, surgical equipments, etc. Here most common rates for depreciation are given. Students should note that depreciation rates will be given in the problem itself. Whenever you are given the problem on the income tax, the depreciation rates will be given along with that. Just for reference purposes, certain blocks of assets have been given and the rates of depreciation for those blocks have been given. First is the building. Buildings are usually depreciated at 10%. Furniture are depreciated again at 10%. Machineries are always depreciated at 15%. Motor cars used for business purposes are depreciated at 15%. Motor cars used as taxis are depreciated at 30%. Computer and computer accessories are depreciated at 60%. And intellectual properties like patents, copyrights, etc. are depreciated at 25%. Two important points to be kept in mind while calculating depreciation are: first, if any asset falling in the block of assets is acquired and put to the use during the previous year for less than 180 days, then depreciation on such asset shall be restricted to 50% of normal depreciation. For example, let us look at the previous schedule. For example, if you acquire a motor car which is going to be depreciated at 15%, okay, if you acquire a motor car which is going to be depreciated at 15%, but you acquire and put the motor car to use for less than 180 days in the previous year. 180 days means 6 months. Okay, so if you use an asset for less than 6 months in the previous year, then you cannot claim depreciation at 15%. You will only be able to claim depreciation at 50% of normal rate of depreciation. Here the normal rate for depreciation is 15%. So of this 15%, only 50% will be allowed as depreciation. That is 7.5% will be allowed as the depreciation. Similarly, if we look at the furniture, if we acquire furniture and use it for less than 6 months, then we will be able to claim only the depreciation on that furniture at only 5% instead of 10%. Okay, are we clear on that? So for example, if you acquire a computer which is usually depreciated at 60%, if you put that computer to use for less than 6 months, then depreciation on that computer can only be claimed at 30% instead of 60%. Now, second important point is additional depreciation. Additional depreciation can only be claimed on new plant and machineries purchased, and these plant and machineries have to be purchased after 31st March 2006. Okay, if both of these conditions are satisfied, that is, if you purchase a new plant and machinery and you purchase it after 31st March 2006, then the assessee will be able to claim extra depreciation at the rate of 20% on the actual cost of machinery in the first year. Okay, so he will be getting 15% in the first year. In addition to this 15%, he will get 20% on the actual cost of the asset for that particular first year only. Okay, so in the final part, let us just discuss how actually a depreciation is calculated. You may be asked various problems in examinations, and you may be asked to calculate the depreciation or the closing value of the asset. So first thing you have to remember is there are two methods of calculating depreciation. First is the straight line method. Second is the written down value method or WDV method. Under Income Tax Act, only WDV method or written down value method is allowed for calculating depreciation. This is the first important point. Now, what are the steps to calculate the depreciation? First step is to consider the total WDV of the assets falling in the particular block of assets at the beginning of the year. Okay, at the beginning of the year, that is the 1st April 2015. Okay, currently we are having assessment year of 16-17, so previous year will be 15-16. So 1st April 2015 will be our opening value of the opening WDV. Okay, in this opening WDV we will add the value of the assets which have been purchased during the previous year. Okay, our previous year is 15-16, so whatever assets we have purchased in 15-16, we will add it to this WDV value. Okay, third point will be to deduct the selling price of the assets which have been sold during the previous year. Okay, so whatever assets which you have sold during the previous year will have to be deducted. Again, let us repeat the steps. Point number 1, take the opening value. Point number 2, to the opening value add the cost of assets purchased. Okay, from that deduct the selling price of the assets sold. Okay, so point number 1 plus point number 2 minus step number 3 or point number 3. Whatever you get after this series of operations, that is, take 1, add 2 and deduct 3, whatever we get, the balance amount, that balance amount you have to calculate depreciation on that particular balance amount. Okay, this process will become much clearer in our next video lecture, where we will discuss various problems relating to calculation of depreciation. Till then, thank you.